Hey, Simple Passive Cashflow listeners. Today we do not have a guest. It's just going to be me, and I'm going to answer a listener question that I've sort of been talking a lot to pretty much every caller I've been having these last few months. A lot of people, they have done some single family home rentals, and they've kind of gotten to this point. I've got this little funny picture here. Simple passive cash flow 0.0 is getting to a job and making money, and then 1.0 is you start to get that turnkey rental going. 2.0 is this, what we're going to talk about today, is transitioning from being a direct operator in some single family homes, some turnkeys, or maybe some burrs, and to getting into bigger deals as a limited partner, because you value your time more than money. And I think the returns when you're the direct operator, like the turnkeys and single family homes, are greater. But man, is it a pain in the butt to kind of get these things going and keep them operated. And after having a few instances coming up where I had pretty big tenant turnover costs, I realized that I was giving up a lot of my profits away. And I was like, shoot, well, I might as well just be a limited partner in some of these larger deals where the pros sort of run it. But again, they're not like Wall Street investments where there's about a 50 gazillion middlemen. It's you're kind of going direct to the source, and we're not talking about crowdfunding here. And you guys can learn about my viewpoints of the crowdfunding sites and how they're sort of like internet dating websites for people who can't find investors. But you guys can go check that out. Simple Passive Cashflow /crowdfunding. But let's kind of go through this article I read and made. And if you guys follow on the YouTube website, I've got kind of going down this in video form. You can see my fun picture there on the right side with my cool bonsai tree. So if you guys know, in 2016, I paid over $30,000 to get mentorship to be an apartment operator / investor. And I know you guys hear me saying that term a lot, operator. Operator is the person actually doing the work, as opposed to a syndicator, which is sort of a ubiquitous term for someone who may or may not be doing anything, and instead of just pitching the deal. So what I learned in this process of analyzing at least 150 properties and going through due diligence on deals, putting in offers, that took over 18 months, is that I didn't really want to be the general partner. And I had enough income and net worth at the time where I was like, well, I could just invest as the passive investor, and I would be on that flight path to financial freedom very soon. So I kind of switched over to being a more limited partner. And this was not my first time being a limited partner in the deal. 2013, I went into my first deal as a limited partner, where again, limited partners where you don't really do much of anything. You just invest passively. And you guys can read about that fiasco at SimplePassiveCashflow.com /fail, FIAL or FAIL. And that's how I lost 40 grand doing that, with just investing with the wrong people. You guys can check that out on the website. And if you haven't heard of syndications or private placements before, I've got about a 1-hour webinar talking about it and sort of discussing it in detail on this SimplePassiveCashflow.com /syndication. There's a link to it, so you guys can check that out also. But assuming you guys know what a syndication is and a private placement is, since this podcast is a little bit more for the advanced crowd, for me, it was simple math. The assumption was that, I grow my money at maybe 15-20% a year, and, in part with cash flow and equity and force appreciation. And I'd be definitely on the way to that financial freedom. And that's why I always talk about, figuring out what your goals are and, investing, having your investment strategy guided towards that goal, as opposed to just, oh, I just want to make $1 million. Or I think some of the dumber goals I hear is, somebody who hasn't even invested in anything, they say, yeah, I want to own 10,000 units. I'm like, all right, good job. Let me know when you do it. But I think you need to have a tangible goal. But I think more of it is like having an actual game plan. What are you going to be doing the next 6 months is probably more important. So this is kind of my story on how I kind of shifted my focus to more non-investing activities and enjoying the journey. And you guys can check out that ongoing journey I have at SimplePassiveCashflow /journey. Again, all these links are in the video on my website for this podcast if you guys are listening. But I think a lot of other people are jumping on the bandwagon with the YouTube channel. So I made the jump from multifamily syndications after 10 years in the single family home mindset. You guys heard back in episode 80 where I kind of talked about jumping from multifamily to single family to multifamily. But today I'm going to talk about how every investor is at different stages of the game. So when do you make that jump to the big show? I kind of talk about this analogy of, going straight to the NBA, the National Basketball Association. A while back ago, you didn't need to go to college. You could just go straight to the NBA. I think the rules are a little bit different these days, but if you are a high performing lottery draft pick in high school, there's really no reason to go to college and possibly taking the risk of injury. You should just go in and get paid and not stop screwing around with college. And in this case, I mean, for a lot of doctors making, over 300 grand a year, I would say that, yeah, don't screw around with single family homes. Just go straight to the bigger stuff, where I would say that the deals are a little bit stronger. And definitely the biggest thing is saving time. Kind of the reason why I've kind of turned my business into more of a boutique syndication business is, like Rome, I think all paths lead to investing in syndications. As long as you are not a jerk and halfway network with people, I think you can sort of get into the deal flow into some of these private placements. And I don't think there's any website for this stuff yet. I mean, again, the crowdfunding sites, but I think you got to go direct to the source to get access to the deals. So the question that kind of comes up, should I invest in syndications or private placements with investment experience? Most investors, they always start off with buying single family home rentals. And I still think that's a great way to start for most people. The natural progression is to move into larger, more scalable assets, such as being the operator, general partner, or passive investor, or the limited partner, in this case, the LP. And we'll talk about, I'll use the acronyms GP for general partner and LP for limited partner, which is the passive investor. These terms are used pretty heavily in syndications. Now, most novice investors do their research and they come to the conclusion after evaluating the scalability, economies of scale, diversification, that bigger deals are better route. But, is that really what you should be doing? I like to use the analogy of a airplane when it comes to these syndications. And, this may be a little bit of a review for you folks, but in this analogy, the general partners fly in the cockpit of the airplane. They're the ones that are finding the deal, negotiating it, finding investors, lining up the third-party property management, and pretty much doing everything. They're typically signing on the debt, and their net worth needs to be greater than or equal to the loan size and have the experience. And those people in the general partnership who are doing that are typically called key principals, or KP for short. So you have the limited partners investors, and those are the guys who come in and they don't sit in the cockpit, they sit in coach, and they sit down, they go to sleep, and they shut up, and they just collect their checks, and they're given investment summaries every month or quarterly, depending on the deal. And everybody's sort of leveraging each other's strengths. The general partners take a bigger cut of the deal, but they're putting in all the work, and they found the deal. And the passive investors are kind of just sitting tight. And the analogy is, kind of works well, because say the investment goes bad. Well, I mean, everybody's sort of in the same plane. General partners and limited partners have alignment there. So, is bigger better? So typically, it does make sense. Larger investment deals, say take an apartment, for example, would bring you larger cash flow and better deals to investors. You just do the math. You typically need $100 to $300 a month per property with a single family home rental. you're going to need quite a few of those to replace your W-2 salary, maybe 20 to 40 of these things. You know, by doing these private placements, what you're able to do is you're kind of going in with maybe $50,000 minimum investment, and you know, you can diversify in a bunch of them. Another good reason that, you know, these bigger deals are better is, unlike when you're on your own or in a smaller deal by yourself, you can pay for a cost segregation that typically costs maybe $3,000 to $5,000. And what this engineering study does is it allows you to break down the components of an investment, and certain pieces of investments are on a quicker depreciation schedule. And because in 2018 they came up with a lot of these bonus depreciation tax laws, you can take a big portion of these deals in upfront depreciation year one. I mean, of course, you're going to have to pay it all back at the end of the sale, but the whole idea here is that you're going to get the depreciation upfront. And it's sort of you know, if your deal lasts 5-7 years, it's a 5 to 7 year interest-free loan in a way. And of course, you know, you can play a lot of games with 1031s and just kicking the can down the road, but I mean, time value of money is a huge thing here. So I personally had 11 single family homes, but you know, after the experience of 1 or 2 evictions a year, and on top of that, you know, big maintenance and capex event that happened 3 to 4 times a year, you know, with that sample size of 11, you know, you extrapolate that out to maybe 30 homes, you're looking at an eviction every other month and a big issue that happens every single month. You know, that's just not scalable, not for somebody who is looking to make a passive return. So I always think, like, the way I look at it, investing in syndications can be an attractive way to achieve true financial freedom because it's more passive than single family homes and more scalable. So here's a caveat that I talk to a lot of people out, and it's very per different people's situations. And you know, I've come up with this rule after, you know, 2016 to 2018, having over 1,000 strategy calls with investors and coaching clients. Today calls are only available to who we do Pipeline Club members just because of the volume. But, you know, many investors, they want to skip over the whole single family homes because these are kind of usually the dreamers. I call them usually the guys without money think this way because they're usually into what's the easiest and the quickest and cheapest way. And they want to jump into the deep side of the pool and start investing in large syndications and deals. You know, who knows if they can swim? Some of these individuals, yeah, they can make their jump into syndication. It's great for them, but keep in mind that this transition is a big step and it requires more capital, something they may not have. You know, investing in apartments is a larger barrier to entry. It requires more skills, more network, and it is more risky. Not something for the newbie, in my opinion. Not something I'm going to invest with. I think in this case, a mentor makes a lot of sense, and you can't really learn it all alone. I mean, I think I see it so much. I mean, they go and they maybe listen to 200 hours of podcasts and they're like, all right, I'm going to go do it. I'm like, good luck, buddy. You don't even know what you don't know. And I'm sure as heck not going to invest with you. So if you're planning on being an operator or general partner with no experience, I think that you're kind of smoking crack, and I wish you luck. Jay Papasan, who was on the podcast a couple months ago, author of The One Thing, sort of agrees there, and I got a link to that in the on the show notes. You always make a mistake, and you know, I would rather see you make a mistake on the first deal that's smaller. And I've said this before in a few podcasts. You know, entrepreneurship, which real estate is a form of entrepreneurship. It's a little bit more conservative one, but it's all about survival. You know, staying alive till you get lucky. And I'm all in for, you know, getting a bunch of single family homes first, and which are effectively like hitting singles in baseball, but then going for the home runs as opposed to, you know, swinging for the fences first. I think by, you know, going into real estate investing as an operator first, you get the benefit of building valuable experience as you mold your track record and branding from start from the rentals. Case in point is, working on this deal, and we're having some trouble with like the Appfolio app with some of the numbers. And, just from my experience, that Appfolio, as, it's great for landlords, but when you get like a bigger building, that software is pretty horrible, I think. I mean, it's great for keeping track of, which unit owes which, but the, putting together the financials at the end of the day, that really needs to be done in a spreadsheet. And that's just some of the experience that you pull from just being an operator with a single family home and a bunch of them. I think the reason why Simple Passive Cashflow has become so popular because it started small and progressed organically. And it's funny, but most of my coaching clients who have just phenomenal W-2 salaries, these are like the doctors, the lawyers, they're the very ones who want to start out small, even though they have so much money that in theory they should start with just being a passive and a syndication. Now, I think it speaks to their character in terms of like, maybe they might be just gluttons for punishment, but these are the people that want to learn it and grind through it and aren't afraid of the hard work, where it's usually the people with no money, no track record, who are just wanting to swing for the fences and just go for it. So just a sort of observation there that I see. If you're planning on being a passive investor or limited partner with no experience, then, there's some room for debate there. Often, more than not, some investors just try and do this on their own. They network with some leads and investors, and they believe every executive summary they read. Now, big in bold letters here, don't be a sucker. This is not a really good approach that I think is good, and not how I do my investing. A lot of the people, they kind of just invest off, what is a cool looking glossy PDF and cool profile pictures, the ones that are like this, and they've got the guy with a suit on and a blue background in the background that's been green screened onto a nice New York City landscape, which is absolutely not what they're investing in, because they're investing in a Class C apartment. But anyway, people for some reason like that, and maybe that's just kind of speaks to why the Wall Street marketing is so effective. So a little bit discussion on risk and severity, where we're kind of on the topic. The biggest problem with being a LP and in a syndication is the potential of working with a shyster who basically takes your money. In my example earlier, I lost 40 grand. So this is a very small chance of happening and can be mitigated by due diligence and creating a network that verifies the character. And I've got a little picture that sort of models this in a risk matrix. And the way I think about it is kind of like, when you go and play roulette, there's the green 0 on the wheel, or the double diamond, which indicates the house advantage. So roulette's sort of 50-50, even number of red and even number of blacks. And if you're playing reds versus blacks, it's sort of even 50-50, unless that 1 out of 100 or however many spaces on that roulette wheel sort of represent, if you land on there, you sort of lose your money. And that's kind of how I see working with that shyster out there. So, how do you mitigate that? I would say just grow your limited partner, your other passive investor network, because those are the guys who are going to tell you if it's a good deal or not. And they may not know if it's a good deal, but they'll at least tell you if the projections were met on their last deal. So being a single family home operator has its huge headaches, as I mentioned, and I've documented in many articles in the past. And I've talked about my $10,000 to $20,000 move out disasters, but I would call this as a very extremely remote, and I use those terms very prescriptively in this risk matrix that I have, and you guys can check out the image on that on the website. But this is where I kind of break down, being a direct operator has higher returns, but it's also coupled with higher risk and headaches, which is probably more important to high net worth individuals, at how it sucks your time. So in my analysis, a risk of a syndication with the right people decreases the variability of the investment performance as shown below in this picture. For example, a deal may or may not perform up to perform. So instead of say 100% return on 5-year deal, yeah, maybe it didn't quite go well, so you get a 70% return in 5 years. It's still pretty good to me, especially when you've got multiple of these deals going through at once, and they're all kind of some are meeting projections, some are doing much better, and some are kind of doing okay. So here's a sort of a very common example that I hear a lot in my calls. And this is kind of the one investor story that I hear a lot. In terms of, their investment ideas or activity, they've got a lot of ideas spinning around in their head. And, the first thing is they're thinking about is, do I go after a duplex, triplex, or quad, or small complex? And I would not suggest going down this path. I call this the mom and pop investor route. This is the path that I was thinking about going into when I first got started. And I just think that a lot of these deals, you just don't have the economies of scale, and the pricing is worse because you're going and competing with a lot of other unsophisticated investors. They're saying that another option here is going into syndications that we're kind of talking about today. But I think that, there's some of their comments are here are, just a lot of questions because there's just not a lot of stuff out there, and it is, very case by case basis. And, the third option for a lot of investors kind of stepping up in the ranks is doing that BRRRR strategy, the buy, rent, rehab, refinance, repeat. I think that it's a good idea if you're a more of a hands-on person, but especially if you're doing this remotely out of state, you're just one single point of failure away from a disaster. I mean, a lot of people aren't partnering with their people on the ground; they're just using them as vendors, and it just takes one car accident away, or that contractor needs some money, that they're just going to pick their family over you and screw you, and you're just going to be out a lot of money and time and energy. So you could pursue a hybrid approach of, sort of doing all of these activities, going in to do a small multi, syndications, and a BRRRR. But if you're going to do that, I would say do the second and third option, going into syndications and doing your own single family home, because I think at the end of the day, you're gonna find that the syndications are the much more scalable and passive thing to do. And then, you don't want to be holding a duplex, triplex, or quad or small apartment, because those are going to be so difficult to sell. The exit strategy just kind of kills you on that, even though the numbers sort of look better than a single family home. The single family home, you can sell it quickly, and hopefully you can get it sold to a retail emotional buyer. So a lot of people are sort of in the stage where they're kind of investing passively into deals, so that they're kind of in the deal flow. They get to see how deals happen. They start to get the monthly updates and all the financials, and they're kind of following along, and they're getting growing their comfort zone. And they're also looking, keeping the old going, maybe keep doing their deals, but, at least that has two avenues for where deals are coming through. I think this is good for people with a lot of liquidity to do more than one track, instead of just being solely a syndication investor, or just a BRRRR strategy investor, but to do everything, but to just pick the best from what's out there. Yeah, I mean, again, my recommendations is, investors get their feet wet with single family home and family home properties first. Then, as previously said, trying to get that experience up. And, there's no way better to learn and to build up a war chest as a prerequisite for more scalable investments in private placement syndications. I believe that once an investor understands that, then they're a sophisticated investor for one, and you can get into deals as a non-accredited investor, and you can more effectively network instead of just running around the room passing out your business card and say, yeah, I don't own anything, and I'm not accredited, but I'd like to invest. I don't think that's a very good use of your time and energy. you'd probably be better off working your day job, more hours at that. But effectively what you're doing here is you're building up your war chest. You're building up your liquidity and your cash flow. And you're also learning and improving your skill sets to be able to call BS when a syndicator starts to use bogus performers and assumptions. You know that, for example, increasing your rent 5% every year, year after year, is not going to happen, because you kind of understand the feel and flow of how much you're doing your rent increases on your own properties, for example. But keep in mind that entering large syndications requires serious capital as a guidance, but not a rule of the SEC. Let's just say you need to have about $100,000 of liquidity as a non-investor to effectively invest in syndications, in my opinion, if you're thinking that the minimum investment is $50,000. I mean, think about it. If you go into a couple deals at 50 grand a piece, you'll kind of blow all your cash, and you won't be able to effectively, without effective cash flow coming in, you're kind of a sitting duck for a year or two. And at that point, more importantly, the education process stops. So if you encompass some experience investing and renting out single family home rentals and employed, at least saving $30,000 a year, I think you're over that threshold where you should probably focus more on private placements and syndications. I've got a little graph that I made that I think a lot of you guys would find useful, just to kind of explain this loose rule on when to exactly make the jump to syndications. On one axis, I have liquidity, and on the other axis, I have the amount of cash flow you're able to save at the end of the year. So it's kind of you can kind of get a sense of, if you're very high liquidity, or you don't have too much liquidity, but you have a lot of investments that's bringing a lot of income a year. So I know you guys like a lot of tables and graphs. So you guys can go to the website, SimplePassiveCashflow.com/syndication. Scroll down a little bit, and you can find that link if you dig through it to get a piece of that spreadsheet. So for some people, they're kind of greedy, in my opinion. They want, higher returns on paper, at least. However, with my track record with single family homes, I lost money on 3 out of every 10 rentals pretty consistently a couple years in a row. But yeah, I hit my overall cash flow of $200 to $300 per month per property. So, I sort of hit my pro forma target. But man, I mean, you throw in an extra disaster in there, another $20,000 to $30,000 repair bill, and then just the needle just goes in the opposite direction and goes quickly into the red. You can always protect yourself from this volatility by getting into more properties, I say, but now you're talking about spending more time into this thing, which is possibly more important. So something to think about in a correction, if you're buying turnkey rentals or sort of retail properties, is that you'll likely be in the red with equity, as unlike being a passive in a syndication, you are not buying with forced appreciation. So today, I'm just trying to sell off all my single family home turnkeys, because even though the cash flow from the turnkeys going into the syndications are going to kind of be the same, it'll be a sort of a wash at high, just under 10%. I see the turnkey rentals having absolutely no forced appreciation potential. So the only place those can go down is, it's down in value, and the syndications have the ability to do some work to increase the value there. So in case there's a recession, that forced appreciation can hopefully keep us up above water. So today, I would say turnkey rentals, you're probably making 25 to 35% a year. And if you guys have seen my video on how I come up with that number and how I do the math, you guys can check that on the YouTube channel. I would say syndications would probably run you in the 80 to 100% return in 5-year range, or 17 to 20% a year. Is this this is less than being your own operator and kind of being that greedy guy who does it all themselves and takes all the returns. But in terms of risk, you're putting in a lot of risk on the general partners that they're holding up their fiduciary roles. Assuming that you kind of mitigate this, as we said, by checking backgrounds and, you know, only working with people you know, like, and trust with 1 degree of separation, the volatility on these returns is much less, I think, and than the smaller rental variety when you're running it yourself. What I like about these syndication deals is it's not done unless there's a lot of meat on the bone. Well, at least the ones that I do. I mean, some people will just do deals just to pick up acquisition fees, but that's your job as a limited partner. Is there a true story here to bumping rents, and are all the assumptions correct? Are there no cap rate reversion tricks being played here, and the numbers sound? That's your job to figure out. And then, you know, what's your equity position in a downturn? And then, you know, always checking the loan terms and if it's a recourse loan or non-recourse. So I would say that 80 to 90%, 95% of LP investors don't know what is a truly good deal and just invest what other LPs say, who probably don't know what the heck they're looking at either. You know, again, pretty pictures is what most people invest off of, which is kind of crazy when you think about it, that the more wealthy people are, the less sophisticated they get. And how do I know this? Well, LPs don't even ask for the profit and loss statements and the rent rolls. So how do they even know that it's a good deal if they don't even have the data? I kind of call the data being sort of like the signal and the analyzer spreadsheet, or some people like to dramatize that as the software, that's kind of like the decryptor. But, you know, you need both of them to kind of determine it on your own to see if it's a good deal, if it's underwritten properly. So on my website here, I've got a sort of a shotgun spreadsheet that'll sort of get you 10% of the way there to vet a deal. It just simply takes the NOI and kind of gives you an evaluation of the property, because a lot of times you want to buy the property based on actual P&L, profit and loss statement, and not pro formas. But yeah, again, you want to build your network and personally vet people, you know, by joining masterminds, conferences, get paid coaching from me if you wish, and I could probably walk you through a deal or two. And, you know, people have done that where they want to go into a deal and they just want to run the numbers with me. And yeah, we can knock that out in an hour. We don't need to be doing that week after week. I mean, that can be like kind of an a la carte thing for sure. You know, one of these tricks that are being played, which I call cap rate gate, is when a syndicator manipulates the reversion cap rate to greatly influence the total returns so they can track investors to a deal. Because most passive investors, you just want to know, well, what's my return in 5 years? So the cap rate, for those of you guys don't know, is a market determinant of how much you should pay per the NOI. It sort of is what it is, and Class A is lower than Class B, which is lower than Class C is the highest. And an increasing cap rate means that it's a softening market and that you're not going to be paid as much for the NOI. And I know that's a little counterintuitive, but that's how it is. So to be a conservative underwriter and a limited partner, you want to take a look at the reversion cap rate, or the exit cap rate is 1% higher as a general rule than the starting cap rate for, say, like a Class C multifamily. So for example, if you started with a cap rate of 6.25, then you want to see a reversion cap rate of 7.25, you know, plus 1%. And there's all different rules out here, different ways of doing it. You know, some people will do like a plus 0.1% for every month or so, or every few months. But at the end of the day, it's usually 1% at the end of the deal. And the reason why the reversion cap rate is higher is because guessing that reversion cap rate is sort of a wild ass guess to begin with. That's you do this because you want to be conservative and assume that you're going to sell in a softer market in the future. So by using anything less than a 0.75% is, I think, sort of kicking the can down the road, and likely what the syndicators will do when they don't make their targets is just blame the economy as the reason for screwing up. But really, it was in that underwriting that they just were using bad numbers. They assumed that they were going to sell on the same kind of market. I've got a little picture here of, how does like the manipulating the cap rates actually affect the return. So let's just say you had a property underwritten, quote unquote, properly with a +1% in the reversion cap rate, and you got 100% return in 5 years. If you use only a plus 0.5% cap rate spread, your 100% return in 5 years goes up to 129% return in 5 years. So they basically created 30% just by screwing around with that one number. So, that's just one of the ways that, a sophisticated investor underwrites the numbers and decides if they want to invest properly. 4 ways sophisticated investors diversify in syndications, and which is the reason why I like to do this, is the first, you invest with different leads and different operators. I always have a theory that people will always sort of pick their family over a partnership. If things always happen to people, and it's just a matter of kind of when. Some people have a higher threshold than others. Some people will lie and cheat and steal whenever. Hopefully you do your due diligence and find those upper threshold people. But I think it's smart to not put all your eggs in one basket and work with different people. Number 2, you want to be in different asset classes. And this is something that I've learned from higher level investors. They go into apartments, self-storage, mobile home parks, assisted living, all kinds of things, because in each of those asset classes are affected by different ways the markets move up and down. Something I've been looking at recently are like retail shopping, which I think everybody is thinking, oh my God, that's the dumbest thing, because Amazon is just going to destroy that asset class. But you have to zig when everybody's zagging. And I think that there's possibly opportunity for the right operator to go in there with the right business plan and picking up the right assets that are undervalued. So yeah, different asset classes, move different with the market, and you want to sort of diversify. And although I know multifamily pretty well, I'm kind of trying to get out of my comfort zone and, get into different asset classes like mobile home parks and self-storage. The third way you diversify in syndications is, different geographic markets. I think Dallas has been a great place to invest, but I don't think it is anymore. I mean, everybody else and their mother knows about Dallas, and most investors have sort of moved on from there, unless they want to bang their head against the wall, and they're looking at places like Atlanta or more tertiary Gulf markets that are emerging markets that you may or may not heard of before. For the last way you diversify in syndications is different business plans. Some are like more like 5-year reposition and sells. Some are more legacy holds where you get your money back or you refinance it in year 3 or 4, and then you hold on for a legacy hold. And when I mean legacy hold, that's, that could mean anywhere from 5 to 10 years or, 10 to 20 years. The saying in commercial real estate is that it sort of goes in doggy years where deals are kind of, it only lasts for a little while. And, to be in a deal for 7 years is a very, very long time. But I think whatever you do, you try and stay as close to the investment as possible, meaning that you try and minimize yourself from, all these middlemen, which is exactly the reason why you don't want to invest as a retail investor in the stock market. You'd like to know your syndication's operating team, and the most important part of the deal is the people. Rule number 1, you don't invest with random people. Even if the operators are good, there is a chance that good operators do bad deals, and it just may be a matter of time before they go after the money grab for acquisition fees because they just have such a large investor list. You want to have the experience of their offering, and understand things, and as opposed to blindly jumping on board because of the promised return on investment. I think you need to get to a point where you analyze the profit and loss statement and kind of do your checks on the big assumptions on the deal and see if the numbers are truly what they are. These items are typically never disclosed to investors, which I think is funny. But that's what you really need to truly vet a deal. As you can see, it's sort of a game of smoke and mirrors. The less data they give you, the less questions, and less questions, the more likelihood of you investing. Do I think that these right deals are good? And I think it's kind of unfortunate that I think most limited partners, they sort of sharpshoot their way out of the deal. They sort of start to look for reasons not to do it, even though it's a good deal. And vice versa, in a bad deal, people get tricked into do it because the assumptions are just very poor. I think we kind of beat the crowdfunding sites to death, but I'll say it one more time. I think that they're great in theory, but sort of on like online dating websites for syndicators who can't find funding. I don't know. Do you really want to work with these people? Maybe one day. I mean, I think crowdfunding sites are in their infancy, and I think that it's great how money can flow right to the projects instead of going to Wall Street and then going to this guy and that guy and finally making the money to where it needs to go. But yeah, not for me at this time. I'm going to stick to what I do because I spend the time and energy to go find and meet these operators. In the end, don't forget your end goal. About 80% of investors who stumble upon Simple Passive Cashflow, they want passive income. Folks start drinking the Kool-Aid or the Simple Passive Cashflow latte, as we say, and you'll be probably financially free in 4 to 7 years, pending taking action. I think always got to keep your end in mind by taking a more passive approach and start designing your lifestyle today. Figure out when you're gonna meet that level where your goal is, and I think you'll be surprised how quickly you're gonna get there. Got a little chart here for further visualization and get on the website if you guys want to grab a hold of that. And the last thing here, I like to put a little disclaimer out for the mom pa investor route. You're thinking about flipping houses. You might do it for the fun of it, which I agree is cool. But for more high-paid professionals, when you factor in the hourly rate and especially the risk of market volatility, you're probably better off staying off at home. I've got that little speech and article that I wrote linked here where I kind of talk about why I'm going to probably stay at my day job. But for the mom pa investor, you got to remember, you're competing with the pros, people who spend their conscious and subconscious time trying to source the best properties and best managing people correctly. You may kick butt at work managing some white collar staff, subordinates who really need that W-2 income because they're mortgaged to the up to their eyes. But that may not translate to leading blue collar personnel. Many deal hunters I know spend off hours taking brokers out to lunch or Dallas Mavericks game frequently to get to the top of the list for the next deal, especially for larger deals, multifamily or self-storage or mobile home parks. It's all done by brokers. There's none of this like off market or wholesale stuff. Your competition is also using overseas virtual assistants, combing seller list for the next deal, all with the best means and methods. And not saying you can't find a deal on your own, but like really, who are you kidding? Let's assume that a 1 in a 1,000 deal falls into your inbox. This is, I'd say at best because it generally, I personally went get over 20 deals in my inbox every day, and a few syndications, deals, a month, and I don't invest in that many. I've probably done 6 this year, but that's kind of the tip of the iceberg of what's out there. And then the other question is like, where do you live? Are you in a place where there's deals? Because something when I was living in Seattle, trying to find deals in the South and the Southeast, is I realized like, unless you're able to take that broker out to lunch every other month or constantly visiting deals and being in person, you're just not gonna be taken seriously. When I invest, I put great emphasis on having a deal sponsor be local to the property, where they can be a passive bird dog to the property and respond to an issue like that. Some investors I know say it's a total deal killer not to have the person live their whole life in that town. You can't have the property management company be your eyes and ears. Maybe this strategy has worked with, the 1 to 8 unit range in the past, but those properties are very forgiving as opposed to when you start to scale up, and especially when you're taking other investors' money. In the end, you got to ask yourself a question: are you okay letting a $12 to $15 an hour employee who is constantly looking for a better gig because the property management job isn't the greatest one in the world? Do you want them to manage your $3 million asset? And the answer should be no, because there needs to be a general partner who is local or making routine trips to oversee the proper progress, especially when there's other money at stake. The mom and pa's, you gotta love them because they make all these mistakes, and they go into single family homes and they follow that logical progression that, when it's a logical progression, you have to scratch your head if you should be doing that in the first place either, but they do it. And they're not the most sophisticated, and they scale up from duplex, triplexes, quads to 8 units, to 16 units, to 20 units. And they read something like this funny article that I have posted here. It's like a nice 4-page PDF on how to get started in real estate, in commercial real estate. And they think they can get some property management and put some like $12, $15 an hour employee in there, and they think they're good. Hashtag BP bro. And I think that this route is very flawed because, first of all, you're going to get killed on the lending terms. Over 4 units and under $1 million loan size is no man's land for lending. Banks know that this is where the amateurs like to play, and they think it's a huge risk for them, and the failure rate is so high. So worse terms, worse rates, and a lot of recourse debt. They're not going to get their non-recourse debt. Number 2, mom and pa's have all their money into deal. Maybe 100 grand, 400 grand into one deal. This is not diversification. As we said earlier, a lot of smart investors usually put in no more than 5% of their net worth into any one deal. Number 3, a few years ago, me and my partner, we were looking for these types of smaller deals under 50 units, and that we were going to kind of team up and do together without syndicating. But we did this because we're still a little wary about the whole syndication process, and since it is pretty daunting, and we get a trust factor, trusting other people like anybody else, but usually that's just a sort of a shortcoming, I think, in terms of vetting people, being able to vet people, and trusting people, and properly protecting yourself. But as we started to look into these deals and started running the numbers, we realized that the pricing was way worse in this lower echelon of properties. That until we got over 60 units in a deal, the competition of unsophisticated mom and pop investors was so prevalent that the pricing just sucked. So lastly, mom and pop investors, they usually suffer from trust issues. They usually have severe blind spots, and it's rare that they are a sophisticated, well-connected investor. Yeah, they bust their butt and take painstakingly care of the property and pick up trash whenever they're there, but that only takes you so far. What I like about mom and pop investors is that they eventually screw up and they sell to us sophisticated investors at a discount. And I know that's not nice, but that's the truth. So there's some commentary from other Huido Pipeline Club members here, and I've got some other resources on turnkey rentals, the big great turnkey rental resource page, and I bet you guys can go to simplepassivecashflow.com/turnkey if you're still doing that. And again, check out the webinar and syndications, and there's a few other deals that I put up some education seminars, webinars on that you guys can check out on simplepassivecashflow.com/syndication. So remember, if you guys are a non-accredited investor, you got to follow the rules. You got to build a relationship because it's very risky for a syndicator to bring you into a deal. I'm giving calls to Hui Deal Pipeline Club members. I've kind of closed it off to just the general public. But if you guys are in the club, simplepassivecashflow.com/club, you guys can sign up for a free intro session there. I try and just kind of help you guys out however I can. And then, at least you can kind of meet a new person. And I always kind of get a little insight in what other people are doing there. Great way for me to grow my network too. So always interested in meeting other people. But yeah, thanks for listening to guys, and make sure you go to the website and check out the resource page here. All right, we'll talk to you guys later.